Okay, I want to finish up the very last chapter, chapter 22, by doing a couple of exercises and a few problems out of the back of the book. So we're going to start with exercise number 10 on page 32. God bless you. All right, so on this one, Newton Company introduced a line of laptop computers in 2013 that carry a one-year warranty. Based on experience with other computers that it sells, they estimated warranty cost of 3% on net sales and used the expense warranty accrual method. So in 2013, their sales of this particular laptop were $5 million. And at 3%, they recorded a warranty expense of $150,000. In 2014, based on the previous year's actual warranty cost, they have revised this estimate for these laptops down to 1% of net sales. And in that year, they had $8 million of sales on this laptop. So if you recall, in this chapter, there are 4 possible changes or errors, all right? And then there are 2 ways of treating those 4 options. In every case, well, 3 technically. In every case, for the first 3 types, the first 3 types are a change in accounting principle, a change in an accounting estimate, or a change in a reporting entity, all right? For those 3 types of changes, you can either do it prospectively, which means you do it today and going forward, or you can do them retrospectively. So first off, what is this of those 3 options? Last week of class. Is this a change in an accounting principle, change in an accounting estimate, or a change in a reporting entity? Estimate. You're changing your estimate from 3% down to 1%. So now you got a 50-50 shot. Are changes in accounting estimate prospective changes or retrospective changes? Prospectives, you just change it. So you debit warranty expense, take the $8 million, multiply it by 1% now, and you'll get $80,000. And that is your estimated warranty liability. That's it. All right, let's look at the next one. Number 11 starts on the same page and goes on to the next page. Number 11 and goes over to 33. On this one, on January 1, Kenfelter Company purchased a building for $520,000. The building had an estimated life at that point in time of 20 years and a residual value of $20,000. The company had been depreciating the building using straight-line depreciation. At the beginning of 2014, the 3 following independent situations occurred. The first one, they estimate that the building has a remaining life of 10 years for a total of 16 rather than 20. So this is also a change in an estimate. So you're going to make the change prospectively. So what have you been doing thus far? You've been taking 520,000 minus the 20,000 residual and dividing it by 20, or 25,000 per year. How many years have gone by since 2008? Full years. How much?
4.
No. 2014 is right now. So 2008 through the end of 2013 is how many years? 6 years. Or 150,000. So that gives you a book value. Take the 520, subtract the 150, you get 370,000. You're still going to have a residual value, because the problem didn't tell us anything different, of 20,000. So that leaves you a 350,000 depreciable base, and with the new estimated life, you've got 10 years left. So you would book 35,000 debit to depreciation expense building and credit accumulated depreciation building for the 35,000. And that would be your entry going forward. So that's a prospective. So this was option A. Option B of our independent situations. You're going to change to sum of the year's digits. All right? You're still going to take the 370,000, subtract the 20 for 350. Now you're going to multiply it, because we're back to the original 20 years. So on a 20-year life, if 6 years have gone by, we've got 14 years left. So you're going to multiply this by 14 divided by the sum of the year's digits. Does anybody remember the formula for sum of the year's digits? N times n plus 1 divided by 2. So n is 14 times 15 divided by 2, which is 210 divided by 2, or 105.
So what's the formula?
N times n plus 1 divided by 2. So on a 3-year life, 3 times 4 is 12, divided by 2 is 6. 3 plus 2 is 5, plus 1 is 6. So it works, when you're up at the 14, 15 range, makes it simpler. Okay? So multiply this, and you get 46,667 as the 2014 depreciation. Does it make sense? All right, the last one. The company discovered that it had ignored the estimated residual value in the computation of the annual depreciation for the last 6 years. So this is our fourth possibility. This is a flat-out error. You've made a mistake. So what have you been doing? You've been taking 520,000 over a 20-year life for 26,000. You should have been taking 25 per year. That's an overstatement of depreciation expense on an annual basis of $1,000 times the 6 years that have gone by since you bought this building, you need to reduce accumulated depreciation by the 6,000. And what would be the credit? I'll do half of it. I'll put the number up there. The credit's going to be $6,000. What's the account? What account do we use for correction of errors? Where has all of this overstatement of depreciation eventually gone? You've been understating net income because you've been taking too much expense. And net income goes to where? Huh? No. Retained earnings. Cash? Come on. If they ever start paying accountants cash for mistakes, boy, we'll have a lot of fun then, won't we? That'll be a whole cottage industry, because I can make a mistake with the best of them. I'll be rich. So, okay? All right. Let's do some more complex, but along the same vein. Let's do problem number 8. Problem number 8, starting on page 38. At the beginning of 2014, Holden Company's controller asked you to prepare correcting entries for the following 3 situations. The first one, machine X was purchased for $10,000 on January 1, 2009. Straight line depreciation had been recorded for the 5 years, and accumulated depreciation had an account balance of $45,000. The estimated residual value remains at $10,000, but the service life is now estimated to be 1 year longer than originally estimated. So we had a cost of $100,000, a residual of 10, for a depreciable base of 90,000. We originally had a life of something. We don't know. It doesn't tell us what the original life was. But whatever that original life was, it's now 1 year longer. So how do we know? Accumulated depreciation is $45,000. And we're 5 years in. We've used it for 5 years, divide that by, and we get $9,000 a year on a $90,000 base, which, drum roll, gives us an estimated life of we've been depreciating at $9,000 per year, And the depreciable base was 90,000. How many years? 10. Thank you. So now we have a book value of 55,000. That's the 100,000 minus the 45. Still have a $10,000 residual value. God bless you. And now we have 6 years remaining. We would have had 5 on the original life, and we've extended that. So that gives us $7,500 in depreciation expense for machine X for the current year and going forward. Number 2, machine Y was purchased for $40,000 on January 1, 2012. It had an estimated residual value of $40,000 and a service life of 8 years. It had been depreciated under some of the year's digits for 2 years, and now the company wants to change it to straight line. So in 2012 and 2013, we had a depreciable base of 40,000 minus 4, or 36,000 times 8. What's the base on some of the year's digits? What's the formula? N times n plus 1. So 8 times 9 equals 72 divided by 2, 36. Or 8,000. And then the same 36 times 736 is 7,000. For a total of 15,000. So we have a book value of 40,000 minus 15, or 25,000, and we have 6 years remaining for a total of 3,500. And the last one that they gave you was machine Z. It was purchased for $8,000 on January 1, 2013. Double declining balance depreciation had been recorded for that 1 year. Estimated residual value is $8,000 with a service life of 5 years. The computation of depreciation erroneously included the estimated residual value. Because what do we do with double declining balance? We multiply twice the straight line rate times the book value, not the depreciable base. So what we had been doing is we took 80,000 minus 8, which equals 72,000, and we multiplied it by twice the straight line rate. So what's the straight line rate on a 5-year property? Last week of school, huh? You've all become mutes. How do you compute the straight line rate? You take 100% and divide it by the number of years, which is 20%. Double it would be 40%, and this is 28,000. That's what we took. What should we have taken? We should have taken 80,000 and multiplied it by the 40% for 32,000. So, we made a mistake of, I'm sorry, this is 800, 28,800. We made a mistake of 32,000. So how do we fix it? And we took not enough. We understated depreciation now. So now we're going to debit retained earnings and credit accumulated depreciation by 3,200. And what is the current year? So that fixes the problem from 2013. And then we have to record the depreciation expense so if we'd done it correctly, we would have a new book value of 48,000 times 40%, or 19,200. Aren't these fun? All right, the very last one I'm going to do is problem number 9. Now this one's interesting because it is asking us in requirement A is, well, let me read through the problem. At the end of 2014, while auditing Sandlin Company's books before the books have been closed. So what happens when you close the books at the end of the year? You take all the temporary accounts and you dump them into retained earnings, right? All of the revenue accounts, all of the expense accounts, all the depreciation accounts, the gains and losses, everything gets zeroed out. So on January 1, you can start anew, right? So in each of these 3 situations, they're all errors. In each of these errors, they're asking you what journal entry would you do to fix if the books have not been closed. All right? So in other words, the temporary accounts are still there. And then, just to add a contrasting level of complexity to all of this, that assume instead in requirement number 2 that the company discovered the errors after it had closed the books. So at that point, what would you have to do in order to fix these 3 errors? All right? So I'm going to put the before over here on the left side of the board, and I'm going to put the after on the right side. So this is before. Halfway down, we'll put after. All right, let's do A. The first mistake, a building with a 30-year life, no residual value with straight-line depreciation, was purchased at January 1 of the current year by issuing a $90,000 non-interest-bearing 4-year note. The entry made to record the purchase was a debit to building and a credit to notes payable for $90,000. 12% is the fair rate of interest on that note. So first off, what's the mistake? 90,000, is that right? Sure, why not? Can we get on? No, what do you have to do with non-interest bearing notes? You have to calculate the present value, because that's really what you paid for that building, is the present value of that $90,000 note. Okay? So, we recorded a building and a note payable. For $90,000. If you have not closed the books out, the proper thing to do here is reverse this. Reverse the mistake. And then book it properly. The note payable is, in fact, $90,000. But the present value of the building, of that $90,000 note, which is going to be 4 years down the road at 12%, you'd have to go to your tables, look in the 12% column down to row number 4, and you'd have to get a factor. And that factor is 0.635518 on table 3. The present value of a single dollar. And that will give you $57,197, which is a $32,803 discount on notes payable. Then what you would have to do is, well, you'd have to now accrue the interest. Which is the 57,197 times 12%, or 6,864, and that credit is discount on notes payable, reducing the note payable by the effective interest method. Now, if it's a 30-year building and you mistakenly also booked the depreciation expense, which would have been $3,000, you need to reverse that also. So you would then credit the accumulated depreciation on the building for $3,000 and debit the $3,000 depreciation expense. So I'm not going to write the reversing entry up there because you know what I'm talking about. Hopefully, right? If you mistakenly depreciated the building at the $90,000 value, you need to fix that too. The correct entry should have been, well, here, I'll write both of them. I got room. Accumulated is 3,000. Removing that, and then depreciation expense. And then the correct one would be debit depreciation expense, credit accumulated depreciation, by 1907. And that's the 57,197 divided by 30. All right? So if you have not closed out the books, always fix errors by reversing the other one. It just makes it easier, cleaner for your auditors to follow. Okay? Because most audits nowadays are fixed fees. You, based upon prior history, you negotiate with the audit firm a flat fee for the audit. So what the auditors need to do is come in, and every time they find anything they don't understand, they say, oh, I don't know what's going on with this entry, so we need more money. That's the game. I'm serious. That's what happens. All right? So you always want to clean this up, because here they'll see it. They'll see you booked a building, a debit to building, and then you credited it. Well, if the debit and the credit are exactly equal, you know it's a mistake automatically. You don't have to go ask questions. And then you'll see another entry for building at 57,197. Okay. We understand that. All right? Same with the depreciation. But what do you have to do for all of this if you had already closed the book? So in other words, everything associated with a temporary account, the interest expense, the depreciation expense, all that stuff had already been closed. What do you do then? Well, you now have to fix it by discount on notes payable. And that's the original 32,803 minus the 6,864 that you had already amortized. So that leaves you a net fix of 25,939. Your accumulated depreciation is overstated because you originally took 3,000 and you should have only taken 1,907. So the net on that is 1,093. You have to decrease retained earnings. Because you overstated by, bless you, 1,000, sorry, let's do one. Let's do it this way. You understated interest expense by 6,864. But you overstated depreciation by 1,907. I'm sorry, 1,093. So your net to retained earnings is $5,771. And then you've overstated buildings, so you need to reduce the building by the 90,000 minus the 57,197. So you're going to credit 32,803. And then put together a really, really easy to read work paper to hand to the auditors when they come in, because they're not going to understand this. Okay? You see the difference between what you have to do? The moral of the story is find your mistakes before you close the books out. Okay? All right. That's the first one. Let's go to the next one. B. The inventory at the end of 2014 was found to be overstated by $15,000. At the same time, it was discovered that the inventory at the end of 2013 was overstated by $35,000. The company uses a perpetual inventory system. So a perpetual inventory system is you take beginning inventory, you add in all of the purchases that you made throughout the year, and then you go out there and you count all the inventory. Well, somebody for the last 2 years has been counting the same room of inventory twice. The value in that inventory room was $15,000 in 2013, and now there's $35,000 worth of inventory in there. So there's 2 mistakes here. All right? So, how do you fix it? Well, the prior year, you need to, because what happens with the $35,000? Let's start there. $35,000 overstatement of ending inventory did what to cost of goods sold? It understated cost of goods sold. All right? So, we need to, and understating cost of goods sold overstates gross margin, and it overstates net income, which in turn overstated retained earnings. So here's the tricky part. What did it do to current year calculation? If the $15,000 mistake could never happen, don't worry about that one yet. Just the $35,000. What does that do to current year's cost of goods sold? It understates cost of goods sold because now your beginning inventory is too much. You added in your purchases, so your goods available for sale is overstated. So if you had subtracted out the correct amount for ending inventory, you would have understated cost of goods sold. So now you need to take this to cost of goods sold to fix the current year. All right? And then what do you do with the $15,000 error? What is the $15,000 error in ending inventory doing to which two accounts? A $15,000 overstatement in inventory means you need to reduce inventory to get it back to the correct amount. And an overstatement of ending inventory understates cost of goods sold. I'm sorry. An overstatement in ending inventory, subtract that from goods available for sale, overstates the understates the cost of goods sold. So you need to add to cost of goods sold for the current year's $15,000. So that would fix those two entries. Well, what about if you had already closed the books? I'll take the $15,000 first. Rather than cost of goods sold being understated, we've now understated retained earnings. So 15,000. And we still need to adjust inventory to its correct levels. All right, so that fixes the current year, 2014's mistake, by just simply reducing retained earnings. Okay? Because we have understated cost of goods sold, which overstated gross margin, which overstated net income, and overstated retained earnings. What about the $35,000 error? If we'd already closed out 2014, what happened to that error? It fixed itself. Because it overstated inventory back in 2013, which overstated cost of goods sold, understated cost of goods sold, overstated net income, and overstated retained earnings. So retained earnings at the end of 2013 was too high. But that means beginning inventory for 2014 was too high, which goods available for sale is overstated. If you correctly took out, assuming the 15,000 error didn't happen, you correctly took out ending inventory, now your goods available for sale is too high, understating gross income by gross margin by 35,000, understating net income. So it fixes itself. So if you had already closed out 2014, this error, no entry needed. It is what is known as counterbalanced. It fixed itself. The last one. For the last 3 years, the company has failed to accrue salaries and wages. All right, so you've been booking salaries and wages when you actually made payroll, when you actually paid out the cash, but at the end of every one of the last 3 years, you have not been accruing wages earned but not yet paid. So the entry you have not been making is the debit to salaries and wage expense and a credit to salaries and wages payable. All right? That's what the mistake is. And it gives you the three amounts. In 2012, it was $12,000. 2013, it was $18,000. And then the current year, it's $10,000. So how do you fix this mess? Let's start with the 2012 error. If 2014 books have not been closed, what happened to the 2012 error? You guys are killing me. I know, it's a long 16-week semester. But this is very likely the last time you guys are ever going to hear me talk, other than a review. It counterbalanced. Because in 2012, you understated salaries expense, which overstated net income, overstated retained earnings. But in 2013, when you actually paid the payroll, you started 2013 by overstating salary expense, which would have then understated net income for 2013 and would have fixed the 2012 error. Does that make sense?
Do you normally keep so many years open?
No, none of these are open. So that one is already closed.
Oh.
Yeah, 2012 and 13 are closed. 14 is the only one that's open.
Oh.
All right?
We were doing
No, it's still in the before, because this is before just for 2014. All right? 2012 is closed. But the 2012 mistake fixed itself in 2013. All right? What about the 2013 error? What did it do to 2014's books? Once again, you understated 2013, which overstated net income and overstated retained earnings. That's still there at the end of 2014 before you close out the 14 books. So this one, you need to retained earnings for the $18,000.
Could you just leave that alone and when you close 2014 have it fix itself? Or would that be
No, that would be wrong.
so it would be like the 2012?
Because what did it do to 2014's books? It overstated salaries and wage expense. And if you just left it and closed it out, now granted, the retained earnings would be right, but current year's net income would be wrong. So here, the credit is exactly what you're getting to. You need to credit salaries and wage expense. And then lastly, for the 2014 error, no harm, no foul, because you haven't closed the books out yet. You just need to book the entry. We haven't made any entry for 2014. and then set up the payable for the 10,000. So what if you already closed the books out? Like you were alluding to. This one's fixed now. Okay? Just like the 2012 was before we closed out the books. So what do we have to do? We have to treat the 2014 error like we did the 2013 error before we closed the books. So now we need to debit retained earnings and credit salaries and wage expense. Because we were getting ready to overstate 2015. I'm sorry, payable, not the expense, because we haven't. Yeah, we've closed out the salaries and wage expense for 2014, but we now need to properly accrue the payable and fix retained earnings because it was overstated. All right, does this make sense? I hope you have a long and fruitful career never making mistakes. That's my desire for all of you, because this is the mess that you have to deal with.
Yeah, you're just sending out your cell phone number.
Yeah, not a problem.